still in this energy crisis, the war in Ukraine. Russia has signaled that they're not necessarily willing to play ball. On the other side, Trump's come out and said, hey, we're going to drill, baby, drill. And my counter to that is, well, BRICS. BRICS is kind of this breakaway. I don't want to say breakaway, but it's a little bit like the G7, except it involves Brazil, Saudi Arabia, Russia. It involves all these other countries, and they're looking at basically doing an alternative currency.
If they could exclusively do trade with the BRICS nations, then you've got my attention, because that's the kicker there. Do you think that is a possibility?
Is there? It could be 3 years, who knows? But now's the time to get in. A European, citizen right now sitting in Bulgaria, you're going to be utterly concerned because your primary source of heat is natural gas. We've been cut off from Russian natural gas supply, and it's about to get freaking cold come this winter. And if the ability you're going to heat your home, you're going to have to be paying astronomically high natural gas prices. I think the big thing to worry about is
Bing bong. I am back with another edition of the Macro Insights podcast, where I've got the man, the myth, the legend, Michael Tanner in the house, who serves as the VP of Finance and Analytics for Trevino Resources and Pesco Accounting Operations, where he oversees the finance, accounting, and engineering analysis. But behind all that, Michael is an expert in the oil and gas industry, where he wants to talk a lot about oil and gas, comparing it to syndication of real estate. But before we get in all that, Michael, I've got a question for you based on the price of oil and gas. Last year, we saw the potential of an energy shortage. They were all freaking out that Russian oil, with everything going on, that it could reach up $100 a barrel. Now, do you think we're fully out of this, of a potential energy crisis? And is that potentially have been overblown? Or is there still something to worry about here as we've drained the strategic oil reserve and everything like that?
Well, first off, thanks for having me. To your question, I think you really have to answer that question, you have to put yourself in different stakeholder shoes. I think if you're a European, citizen right now sitting in Bulgaria, you're going to be utterly concerned because your primary source of heat is natural gas. You've been cut off from Russian natural gas supplies, and it's about to get freaking cold come this winter. And if the ability you're going to heat your home, you're going to have to be paying astronomically high natural gas prices. So I think if you're a European energy consumer, UK, anyone in kind of that northern European belt, you're definitely going to be concerned. I think for the price of oil, and I think if you're a United States consumer, one, we have a crap load of natural gas, so I wouldn't be too concerned about prices going too crazy there. In terms of oil price, the big thing right now as we record this, we're post 2024 election. Thank goodness. I was tired of talking about that. But the real question is, okay, well, what now is this new administration going to do to prices? I think it's a little bit of a mixed bag. You could make the case for exactly what you said. Hey, we're still in this energy crisis. The war in Ukraine, between Ukraine and Russia, is still raging. Russia has signaled that they're not necessarily willing to play ball. And Trump has come out and basically, on the other side, Trump's come out and said, hey, we're going to drill, baby, drill. And my counter to that is, well, great. If you can tell somebody to do something, but if the incentives aren't there for them to actually do it, are they going to do it? And what I mean by that is Trump can say drill, baby, drill all he wants. But the real question is, will these oil companies actually decide to go drill? And a lot of that has to go with the shift of sentiment that the energy and specifically oil and gas companies have had over the last, 20 years. To do a quick history lesson, from 2008 to 2018, the public markets, the capital providers, banks, all of your public institutional investors rewarded oil and gas companies for one thing: increasing production. Your increase of production was highly correlated with your ability to go get leveraged finance loans, tap the public equities markets from a debt standpoint, and all the rest. Well, that sentiment began to switch from that latter part, from 2016 to 2018. We saw an enormous amount of bankruptcies because at the end of the day, necessarily producing oil doesn't necessarily mean you're producing it profitably. And at some point, that rooster comes home, or that chicken comes home to roost. And what happened was you saw a wave of companies basically drill themselves into bankruptcy. And so that sentiment has switched now. Companies in the last, I would say, 8 years have really focused on, okay, we are going to drill only when we are certain we're going to make a profit. We're not going to go drill a well that we know we're going to lose money on. we're not drilling dry holes here, but there are wells. If I spend $10 million to go drill a well and I only get $8 million of revenue, well, there's a $2 million loss in there that someone's going to have to wear. And before, companies were willing to take that because it was all about increasing production and their stock price would rebound from it. But now in this mode of the capital markets not necessarily rewarding people for just drill, baby, drill and increasing production, I have a hard time seeing that the bear side of this question that you asked of, will prices go down? Well, I don't think so. I actually think we're in a sweet spot right here. A lot of people are signaling that in 2025, the market is a little bit oversupplied. Some of that's going to have to do with what OPEC does. So, to roundabout actually answer your question, no, I don't think we're in an energy crisis. I think we are supply and demand are fairly steady, but I don't necessarily see a huge downside potential from here, nor do I necessarily see that huge upside potential.
So you think we're going to basically crab walk here throughout 2025? Is that what I'm getting at?
I do. I think you've got counterbalances on both sides. You do have the drill, baby, drill stuff, and maybe there are some companies who decide to drill. We can get into why drill, baby, drill is sort of just a much more of a tagline than it is actually a policy that somebody can implement. And on the upside case, on the bull case, countries like Saudi Arabia, OPEC in general, they're 90 to 95% of their revenue, specifically in Saudi Arabia, comes from oil and gas. They've been extremely forthright about saying we want to bring that number down. We want to diversify our economy. So they're really in this catch-22. In order to invest in other parts of the economy, they need high oil revenues so that they can take that money and move it around into other parts of their economy. So if they don't have high oil prices, they don't have enough money to move and diversify. So they're really caught in this weird catch-22 of just almost like a downward cycle. We've seen over the last 6 months, specifically, they've decided to, beginning of the year, they signaled, hey, we're going to add more barrels to the market. OPEC's been holding oil barrels off the market for the past 2 years now. It become the beginning of this year, they're like, hey, we're going to dump oil. We're going to start bringing all that oil production back online. 6 months ago, they said, we're not going to do that. 3 weeks ago, they said, we're not going to do that. And we may not do that in 2025. So I think there's a lot of chatter on both sides to the point where the way my mind sees it, I think we're in that nice little counterbalance right now. And where we sit now, about $70 a barrel, is probably what I would say the average is for 2025.
Okay. Now, you mentioned a couple things that I want to dive into. You mentioned OPEC. You mentioned a few other things. But first, I want to get into the drill, baby, drill. So with that, what incentives are you, I guess, like kind of hinting towards that aren't there necessarily for oil companies to do the quote unquote drill, baby, drill that Trump has been lining out? So drill, baby, drill is really, if you look at it under the hood, is a facsimile for we need to deregulate. And okay, I'm all for deregulation on some level. I think that specifically, my background, I'm a recovering engineer, so I've kind of spent some time on the engineering side. I moved myself into the finance space. In school where I went, we did a lot of work in the actual mining business. And in the mining business, you could have one mine takes 25 years to build. You've got 9,000 different permits you need to get. Yeah, maybe we could do with 8,500 permits. Maybe we could do with 8,000, maybe 9,500 permits isn't necessarily what we need. So from a deregulation standpoint, there is something to be said. But the real question is, where is that deregulation going to help the most? Well, right now, nobody's not drilling oil wells because the regulations are too cumbersome. It's just a fact. Over the last 4 years, I haven't come across one company who said, man, I'd love to drill this well. We think we made a lot of money, but damn it, regulations got us. No, they're not drilling because they're not sure if they can make a profit on it. So when Trump says drill, baby, drill, what he's really talking about is deregulation, which in my perspective isn't necessarily going to change Chevron, Exxon's, Pioneer's, number of wells they're planning on drilling in 2025. In fact, Chevron's just come out and said, hey, we're actually going to spend about $2 billion less drilling oil in the Permian Basin because we're just going to focus on cash flow. Well, what's that a signal? Well, we actually had some projects we were going to do that, the way we look at it, may not actually be as profitable as we thought. So we're going to wind down our spending a little bit. Where I think the drill, baby, drill, and when you hear drill, baby, drill, think deregulation. Where deregulation is going to hit is those large
capital infrastructure projects. Think LNG export facilities. Think pipelines. I think those two specific sectors are posed for dramatic change over the next 5 years. An LNG export terminal takes 10 years, or not 10 years, let's say 5 years to build, 2 years to put online, 10 years over the full life cycle to plan the whole thing. But let's just say it takes 5 years to build. So your investment horizon has to think long term. An oil well takes, 30 days to drill, 20 days to complete. You're online in less than 4 months. So your investment horizon is much shorter than these LNG export facilities. And those LNG export facilities, as we know, the Biden administration banned new building of them. And what that has done is that's depressed the U.S. natural gas price, because if we have too much natural gas for what we can do, well, we can't send it anywhere. The only way you can send it overseas is through an LNG export facility, because you have to, basically, put it in these big tankers. You have to basically wet it up. There's all this, those crazy engineering you have to do to basically be able to put natural gas in a tanker to send across the seas. So what these LNG export terminals are going to actually do is, in my opinion, cause an increase in natural gas production in the United States, because the price of natural gas in the United States is about $3.30 per MCF. In Europe, what we just talked about, where it's really cold, it's $12 because Putin has shut off natural gas imports via the Nord Stream pipeline, which was blown up. And we can talk about who blew that up. I've got my theories on that. But once these LNG export facilities are up, you're going to be able to take all that natural gas that's sitting here that's not being used and arbitrage it and take it overseas. So the big winner, I think, in this whole deregulation is going to be LNG export facilities. On the other hand, regulation has really been impacting the pipeline space. We have not seen any new oil or gas pipelines have been built in the last 4 years, specifically, since the previous administration took over. We saw Keystone XL get canceled. We saw the Mountain Valley Pipeline have multiple issues, which is that big natural gas pipeline that's getting run down the East Coast. So those have, and so if you go look at just the stock value of those companies, those pipeline companies, they've gone way up over the past 4 years. Because think about it, the regulation has kind of created a natural monopoly. If there's only 3 pipelines that I can send my natural gas down, no one's building them. Well, that I as the owner of the pipeline can charge you whatever you want. I'm charging $5 per MCF. I charge you 20. With deregulation, I think you're going to see pipelines get built in bigger quantities, which I think is great for the overall economy. It's going to lower our energy costs because the fees are going to go up. We're going to be able to transport natural gas and these other liquids across. But I think what you're going to see is actually these pipeline companies become less valuable. And the hint of that happened 2 weeks ago. So EQT, which is the largest natural gas producer on the East Coast, they also own a huge interest in a bunch of midstream pipelines. Well, they just spun out. They announced 2 weeks ago they're going to spin out their pipeline company and create a joint venture with Blackstone. Well, why would they do that? Well, in my opinion, they're seeing the same thing I'm saying. Wait a second. We were just in a 4-year natural monopoly where nobody else could build pipelines. We were the top dogs. Well, now all of a sudden, if more pipelines are going to get built, wait a second. That means we're going to have more competition, meaning our profit margin is going to go down, meaning the value of our pipeline is going to go down. Why would we not monetize it at its maximum valuation right now when there's no new pipelines, and take the cash now so that in 4 years, when we look back, we could have gotten double the price for it? So that's where I think really the drill, baby, drill. It's really deregulation, and I don't think it's going to affect oil as much as it will specifically natural gas with these LNG export facilities and pipelines.
So do you think it'll get us away from more of like the green energy policies then? Because, it's been kind of, I guess a political battle back and forth, right? The left has been very heavy on this green energy policy, the green energy movement. Doesn't matter what you think. This side of the coin is on this side, right? And then, Trump on the right side has been more of the energy dominance. So do you think that is the reasoning why maybe getting away from the green energy policies, or you think that conflict is somewhat overblown?
I think the conflict is overblown from the standpoint of I tend to think the free market will always come to the right conclusion. And right now there are the profit margins within the traditional fossil fuel space far outweigh the profit margins that are coming from the renewable space. I mean, think about, BP just announced they're basically rolling back all of their renewables investments. Their old CEO, who you go look up Bernard Looney and how he ended up getting fired. You'll get a kick out of that one. But he was big. Their old CEO was big on this renewable stuff. Well, he got kicked out for some unscrupulous activities with a colleague. And now the new person that's come in is basically like, well, I've been actually looking at all the numbers. We're losing a lot of money trying to invest in offshore wind, invest in all these renewables. We need to get back to where we're actually making money, which is, if you look at our profit, if you look at our income statement, we're making all our money in energy or oil and gas. Why would we not double down on that? So I think your question of, is there a tension between them? No, not really. I always come back to, I think what's funny is if you guys are watching Landmen right now, Billy Bob Thornton literally stole the quote I like to use. But, if Chevron, he says in this, if Chevron thought wind farms were going to be the next big boom and be the next big profit center of the next 50 years, they'd be throwing all their money at it. But they're not. They're still drilling wells. I think that is an absolutely correct line in that, companies are going to do where they believe and where the free market leads them. And so right now the profits are still in the traditional fossil fuel business and not necessarily the renewables. So from the standpoint of what our company's going to do, they're going to follow the money.
Yeah, that's fair. And I mean, at a certain extent, right, businesses have to make money. They have to be profitable, right? I mean, it's interesting because, like, if you look at the tech sector and kind of everything like that, right, these industries have been kind of prepped up by venture capital and everything else, whereas like the oil and gas industries are more, just brass tacks, right? Traditional business and kind of getting it through there. But I want to dive into OPEC. There's been a lot of controversy around OPEC. Is there going to be an OPEC plus, the disbanding of it, all this kind of stuff? Now, what is your just overall, just general viewpoint of OPEC and like kind of, I guess, their marketed energy dominance is how I'll word it.
What's up, everybody? It's your boy, Brandon, the brains behind Green Candle. Thanks for checking in this new channel I've got here at the Macro Insights Podcast. You can help support me and check out new content that I'm bringing out in short form on different social media channels at Green Candle IT on X, on Instagram, and on TikTok. So be sure to check me out there. And if you want to follow me personally, you can. I got it all on X at bkeys1010 and at Instagram at keys_open_doors. So go ahead and support your boy. All right, enough from me. Back to the show.
So, I mean, obviously, because OPEC is a non-U.S. entity, they're allowed to literally be a cartel. So I think that's the first thing to say. They are, and we say a cartel. A cartel is no more than two or more entities deciding that they're going to follow the same path. So they're literally a cartel in the standpoint of they get together every 2 months. They decide here's what our oil production is going to be. We're either going to raise it or lower it based upon that. I think OPEC, one of the reasons why OPEC exists, I think goes back to, when it was created back in the 70s. You have to remember the United States at one point was the dominant oil producer and controlled the energy market, not just from a monetary standpoint, but from a life standpoint. I mean, think about it. There's this great book called The World is for Sale. If anybody likes, if you're driving home, I got to drive 12 hours back to Colorado tomorrow. I've already listened to that book, but if you needed a book for a long drive, The World for Sale is a great book. It's on the history of basically the energy commodity traders, which are basically the people who, facilitate the movement of oil and gas throughout all these different countries. And what you read and learn in that book is oil, it's a lifeline to these countries. Yes, it's for Chevron, they make money on it, but for a country like Jamaica, for example, they need 400,000 barrels of oil a day, or they can't turn on their refineries, which means their citizens can't turn their homes on. So it does end up being a life or death situation. And so when one entity starts having too much power, there always becomes a counterbalance. And that's what we saw in the 70s when OPEC really came around. Was the US was, 80, not 80, I think it was like 60 to 70% of the total oil production and really was controlling the entire global energy market. And Saudi Arabia, OPEC, or Saudi Arabia, UAE, all of the different nations in OPEC realized, well, wait a second, if we banded together, we would actually create a counterbalance to the United States. And that's really what, lives on today. The United States pretty much handles the Western Hemisphere when it comes to oil and gas production. OPEC controls the rest. The difference is there's some blending issues. We don't need to necessarily get into that. So OPEC is always going to look out for its members. And I think that's the thing to realize, so whether or not you think OPEC is good or not, what their mandate is to look out for their members, and their members make a lot of money off oil production. And so a lot of the times their stated goal is we are going to do what's going to maximize revenues to OPEC and to our host countries of that standpoint. So in terms of what my thoughts on OPEC, it's at this point, OPEC's not going away. It's only going to get stronger from the standpoint of, as these countries continue to become more dominant in the Middle East. It's something we've lived with now for over 60 years. So I'm not, whether or not it's a good or bad thing is somewhat irrelevant, and it's not going anywhere. I think the big thing to worry about is BRICS. BRICS is kind of this breakaway. I don't want to say breakaway, but it's a little bit like the G7, except it involves Brazil, Saudi Arabia, Russia. It involves all these other countries, and they're looking at basically doing an alternative currency. And what is interesting about that alternative currency is right now the oil is and the oil is traded via the dollar. It's known as the petrodollar. Mm-hmm. That gives the United States huge amounts of power in the world because oil is traded in our currency. Well, they've floated the idea of BRICS, this new currency, which, if it ever comes around, that currency might become the new way oil is traded within OPEC. And that would completely change the paradigm of the financial industry. So I don't necessarily think OPEC so much, is interesting going forward. I think they're going to keep doing what they're doing. What I'm interested in is what happens to BRICS and what they decide to do from a monetary standpoint. I know they've talked about doing a digital currency and all that stuff. So who knows where that goes?
Yeah, I mean, let's dive into that because I'm really interested your thoughts. Because to me, just from like my perspective, it seems like Trump and his influence, he's basically come out and said, if you decide to do international trade in any other currency, we're going to cut off all trade with you. We're basically like, you've become an enemy of the United States. Do you think that power that BRICS has is enough? The energy density that they have is enough to potentially go against the United States and just kind of, I guess like slap the hand that feeds them, so to speak.
They could. If they get smart, or not get smart, but if they decide to partner with OPEC, I mean, just think about it. Brazil, Saudi Arabia, Russia, those are three big oil producers, and they're all in BRICS. Russia and Saudi Arabia are in OPEC. So if there becomes open collusion between BRICS and OPEC, yeah, I think you'll start seeing that, to be honest with you. And I think, the interesting part to note is that Russia has shown over the last 3 years that you can survive as an economy not having access to the U.S. markets. I mean, think about it. We shut down SWIFT for them. They've basically gone back to a gold-based currency. And not that things are going great over there by any stretch, but the economy hasn't fallen apart over there yet. So I think the more and more we antagonize the global markets, they're going to like OPEC looking out for their best interest. Other countries are going to look out for their best interest. So I'm very keen on what BRICS is going to do. If they do start doing that, it's really, really going to, I think, hurt the U.S. economy. I think from the standpoint of, just from that standpoint of, we're able to leverage our currency to get, we're 36 trillion in debt. Why is that? Well, because the world uses our currency and it's the highest rated at this point. Well, all of a sudden, if we lose that ability via the fact that the oil isn't traded on the petrodollar, the reverberations within our economy are absolutely insane. So if BRICS did decide to team up with OPEC and do something there, that would really catch my attention. And that would be kind of a massive paradigm shift in the energy business.
Yeah, but the cryptocurrency like that BRICS is like proposing and everything like that. At a certain point, right? You would like, what other assets do the BRICS nations have that would worry you for them to shift over to there, right? Because to me, you would basically need to buy the BRICS currency, whatever it is, exchange it from dollars to get there, then purchase the oil, and then eventually every other country, at least in the short term, is going to want to have dollars. So then they're going to revert back to dollars to do other international trade along those lines. Now, if they could exclusively do trade with the BRICS nations, then then you got my attention, because that's the kicker there. Do you think that is a possibility?
Oh, absolutely. And that's what you're seeing right now happen with Russia trading with China and Russia trading with India specifically. Specifically because of the U.S. sanctions that we put on there. I think you hit the nail on the head there. Right now, things have to flow through the dollars, but if there's some way to go around the dollar, maybe it's Bitcoin. Probably not, because they're going to probably want to create their own digital currency, which, was kind of probably scary from that standpoint, because it's, much like the dollar, it can be manipulated and stuff like that. So if they decide to go around and create their own, and start trading amongst themselves in whatever currency they decide, whether it's digitally backed, whether it's another currency that's available right now, that then becomes a huge destabilizer, both for the United States, and is a massive, as I said, kind of paradigm shift. I don't know if that's where they're going, but I have a feeling they're, and not have a feeling, you can read the tea leaves. They're talking about it. The question is, are you going to be able to implement it? And I'm not so sure about that, because a lot of these countries have debt that's in US dollars. So that then gets spicy, where, Brazil, all of a sudden says, hey, we're going to start using BRICS digital currency to buy oil. Well, the United States might just call their loan, is going to call all their debt right away. And now Brazil's in this very awkward position where they're going to have to, they got to do something, because the U.S. ain't accepting BRICS currency. I'll tell you that much.
Yeah, exactly. That's the one thing that I think that the U.S. kind of still has all the power. Now, I do think that power is waning, and I do think there is some moves that the U.S. could make to potentially gain that back. But in the interim, in the past 4 years at least, we've definitely lost some of that power, and it's been seen from a lot of international conflicts and other things like that. But I want to bring it back home, right? So a big thing that you talk about is the correlation between the oil and gas industry and real estate. Now, I think that there is a very big kind of underlying crack here in the U.S. economy that's been kind of, I guess, shoved under the rug here for a little bit in the commercial real estate sector. Now, how do you view the overall, just the real estate sector, both commercial and I guess like retail sector, or like family housing and things like that? And how would you see the correlations or the differences between that and the oil and gas industry?
Absolutely. So I always say up front, I am not a real estate expert. I've made two small real estate investments in my career. They've both gone horribly wrong. I do most of my investing in the oil and gas space, but really where the correlation, or what I would say the arbitrage opportunity, has come, from the time of 0% ZIRP, policy, 0% interest rates, up until basically 2022. Real estate has far outperformed from an alternative investment standpoint, has succeeded in terms of, beating all other asset classes. I mean, think about it. If you can borrow money at basically 1%, you can achieve some sort of steady dividend on a quarterly or yearly basis. And then you can very easily have a liquidity event via selling that property, because the valuation's gone up so much, and the person who's buying it's able to access 0% interest rates. And, or you can just refinance, recoup some capital for you and whoever maybe your business partners are, and continue to cash flow the property. Well, that's a no-brainer. The switch that happened is when they started raising interest rates. And now all of a sudden your cost basis within real estate went sky high. And a lot of these properties stopped appreciating as much. A lot of these properties now, all of a sudden, the debt service costs were more than the net income that was coming in. And now all of a sudden you had a lot of these, you had a lot of LPs who love to invest in real estate say, well, crap, where am I going to put my money? Maybe the returns aren't necessarily here. And even if they are here, I don't have the chance for a liquidity event. I don't even know if I'm going to have the chance to refinance. This may just be a massive 10-year lockup. And so from the oil industry, we looked at it and said, hey, we're over here. We're the other alternative asset class that specifically has not the answers, but is designed to basically the pros of investing in oil and gas are basically opposite of the cons of why real estate was failing. AKA there's very little debt specifically in the retail oil and gas sector. Everything is raised on equity, which is great. It's an industry designed to hand out monthly revenue checks because we have to run revenue every single month for all of our other working interest partners. And number three, there's a huge buyer pool available to achieve liquidity events along whatever time horizons you want. And then the fourth is insane tax deductions. And I end with that because I really want to hit the nose on the head. The oil and gas business, one of the reasons why these talking heads on TV, we subsidize the oil and gas business. Well, they're somewhat lying to you. The oil and gas business is not subsidized, but the tax advantages of investing in oil and gas are absolutely incredible, specifically due to the IDC, the intangible drilling cost, which is basically basically every dollar that gets spent going into the dirt to drill an oil and gas well, you can write off on your taxes. And you can write off not only off passive income, but also on active income. And that is where the huge arbitrage opportunity, once you layer the tax benefit in with now all of a sudden the equity multiples are the same as real estate and there's no debt involved, so you don't have to worry about your debt service costs blowing up your investment. It all of a sudden became a massively attractive asset class to your high net worth W-2 individuals, your small family offices who said, wait a second, we pay taxes, so I want to lower my tax deductions where I can actually get some sort of quarterly distribution. And I can actually, over a 7-year time horizon, actually achieve an liquidity event. It was really a paradigm shift. And we saw specifically at Trevino Resources, we saw a huge amount of retail capital and institutional capital from kind of that small family office side become unlocked. And we're calling us saying, hey, do you guys got deals we can get in on? Because we need all this. We can't put money in real estate. We've got to find other asset classes to put in there. So that's really the arbitrage that we're seeing right now. And to today, that exists. I mean, we're still at, a traditional home mortgage is 7%. I don't know what commercial real estate interest rates are going at, but the arbitrage between what's going on in just the overall real estate sector and the direct investment within oil and gas has really never been bigger, and it's shown specifically with what we've seen coming in here at Trevino Resources.
Yeah, so that is really interesting here, right? Because it seems like there is some sort of I guess arbitrage, but it all kind of depends on the interest rate environment now. Now, will that shift for you? I guess the thought process, will that shift for you if Trump and Powell Trump kind of comes in and convinces Powell to lower interest rates, because I think that would cause some sort of an asset bubble, I don't think we're out of inflation. And if you look at a lot of the way that data was previously calculated, it doesn't appear to be over just yet. Over meaning talking about inflation. So yeah, what is your viewpoint on that? If we lower the interest rate environment and how that could affect things going forward?
Well, I think I 100% agree with you. I think if we lower the interest rate, we're going to put ourselves back in the same position we were at, from an inflation standpoint. I mean, it's clear right now that, when we continue to print money, the money supply goes up. From just a pure money supply demand standpoint, you begin to see inflation happen. That's obvious. And I would say from a macro view, we've needed to have non-zero interest rates now for probably 5 years. And we ended up being 5 years too late. Obviously, COVID was a unique circumstance from that standpoint. So I don't see the interest rate really going down crazy. I mean, they cut 2 days ago, the Fed came out and cut, a quarter point off the Fed funds rate. but the market tanked. I remember my dad called me, he goes, they just cut rates and the market's tanking. Why? And I said, well, because the market knew they were going to cut a quarter point. What the market's reacting to was Jay Powell's speech of, I think 2025, we may not be able to cut as much as we thought. And it's always the future forecasted cuts that get baked into the economy. So, or baked into kind of how the market views this stuff. So do I think they're going to cut rates more aggressively? I don't think so. They might, but we got to get a handle on inflation. If all of a sudden tomorrow rates were zero, well, then I go back to the old emphasis of, well, real estate then becomes a lot more of an attractive opportunity. Because now our cost of capital is basically zero. I can then go get into these properties with very low interest rates, which means I can actually give myself a dividend. I think the other, and this is again, not my area of expertise. I'd be interested from your standpoint. I think the liquidity option of selling the property is still hard because prices have gone up so much that a lot of people are locked out. I don't know how you see that from a liquidity standpoint. Maybe you can refinance, but if I can't flip my property, now all of a sudden I'm locked up, right?
Yeah, I mean, 100%. I think, to be honest, like a lot of these major markets have seen such a rapid increase in pricing relative to like rental pricing where, because taxes have gone up, because interest rates have gone up, because house insurance has gone up like 40-50% in all these different places, the investor market is just simply just not looking to purchase and make deals right now, which is greatly affecting the overall just real estate market in general. And I think a lot of these major buildings, the big apartment buildings, the kind of commercial real estate buildings, they have a lot of floating interest rates, right? And they're valued based on the rent. They're valued based on the rent that they're able to achieve, right? So obviously during COVID, we saw a mass exodus from places like New York, LA, San Francisco, all moving to remote work, one, but two, also to, more friendly places as far as like taxes and everything else, because everybody could, they had that capability to do that, and, cheaper places to live, et cetera, et cetera, et cetera here, right? So now companies are trying to force people back into the office, and that's kind of like a growing trend because they're realizing people aren't as productive at the home opposed to at the office. Well, go figure. But, that trend kind of change the game a little bit where people need to be more flexible. Maybe, people are more required of a hybrid environment opposed to just full time in the office. So they'll live close to this place, but the office space isn't as desired, right? And so these commercial buildings have seen kind of a big effect, and people aren't looking to buy it or deploy this capital because it's viewed as more of a risky investment instead of like a sure thing that many people thought it like commercial real estate was back in, 5-6 years ago. I mean, really not that long ago, right? So, real estate's always interesting, right? Because there's always this meme where it's like, oh, like, I'm so good at real estate, but really it's like a little kid dunking a basketball and their dad like propping them up, right? And in the dad is inflation, right? I mean, in reality, just real estate, you don't have to be that good at it. You just have to bank on that, that the underlying dollar is going to get inflated. And the Federal Reserve tells you they're going to do that at least at 2% every single year. So long-winded answer to say that I don't think that the amount of liquidity is going to go directly into real estate as we've seen in years past. But I do think we're going to see an asset inflation where a lot of people are going to try to get more prices, because I think a lot of people have been waiting on the sidelines to say, oh, I'm going to buy when, interest rates are back down. But in reality, that doesn't really make for too much of a buyer's market. It's just we've had so many people get into a interest rate of like 3% or under. I think like over 60% of mortgages are at 3% or under right now. So, people are going to either feel trapped and not move from their current house that they're in, and that's going to cause a supply shortage, which is what we've kind of seen, and the reason why real estate has continued to go up now. And I think that's going to continue here going forward, where the supply of real estate, just like the lumber, the labor, all that kind of stuff is just getting more and more expensive. So it's not going to be looking at as good of an investment as maybe we've seen in years past.
Well, that's really interesting. I think your image of dad holding up the guy dunking a basketball is really interesting, because I think with any investment, it's all about playing the cycles right. I would love to invest in an asset class where my dad could hold me up and I dunk a basketball. I mean, that's great. It's all about waves and timing the market right, which is why we've kind of for the last year and a half been banging on the table saying, hey guys, now's the wave in oil and gas. You want to get in and ride a wave ride a wave that's going up right now. Who knows how long it's going to be? It could be the next 5 years that the arbitrage between oil and gas and real estate is there. It could be 3 years. Who knows? But now's the time to get in. And that's really why we've been banging the table on that. So I think it all, like you said, just comes down to timing and reading the market correctly from an entire alternative investment standpoint.
Yeah. And I mean, I hear you on that, right? I mean, I think it's all about timing and like the different cycles, right? I think so different industries really prosper in different environments, but in the end, there's always some sort of alpha to be found in every industry, right? So, real estate specifically is always like, market to market. It's really, kind of hard to talk about specifics or like broad. It's really a lot easier to kind of talk about specifics, and a lot of real estate people will kind of scoff at, oh, you're talking about just this in generalities. But I think it's always good to have like an overarching picture of what is going on here. Now, you talked about like kind of the differences between oil and gas, and I want to get into like syndication and kind of how you view that. And why don't you break down like what a syndication is just on a very basic level, and then we can dive into, why how to utilize that with oil and gas.
Yeah. So an oil and gas syndication acts no different than your traditional real estate syndication. Hey, we're going to go aggregate LP capital. We're going to go then take that capital and we're going to go buy some sort of oil and gas asset, whether it's a producing oil and gas, whether it's a group of producing oil and gas wells, whether it's some undeveloped acreage and we're going to actually go drill new wells on it, whether we're going to have a combination of both. It operates the exact same way. And so from that standpoint, people who invest in real estate are very comfortable with oil and gas syndication because it's the language they're heard about. They know about 2 and 20. They understand about back end after payout and all the different scenarios. They can understand a waterfall, all that jazz. Now, what I tell people is oil and gas syndications sometimes can take advantage of uneducated non-oil and gas investors. And I say that because they can hand wave about using the same language that everybody is used to and not necessarily look into the numbers. What do I say? Oil and gas is a very, very cost-intensive business. You want to go drill a new well, you're going to have to work with a geologist to help define where the oil is. You're going to have to go hire a drilling engineer or a drilling contractor to help to make sure that your drilling operation is going great. Then you've got to rent the rig. You got to hire all the contractors to go do that. And then you also, before you do that, you got to go acquire the land. That is a huge, huge cost. Way more than real estate. You can almost think of it like a new development from, if you're buying a piece of land, you're going to go actually build a commercial real estate facility versus just buying one that's existing. And what these syndications do is they tack on a lot of fees. And so if you are looking at an oil and gas syndication as investing LP capital, the first thing I would ask is, what are your fees? What's your fee structure? Because what you might discover is that they're hand waving about, hey, we have low fees. Well, they actually do have a lot of fees. And I've seen fees in the oil and gas space be up to, sit down while you hear this, 30%. Woo! You can't make any money doing that. Or you better have 50% IRR projects to do that. So that's the first question to ask from a syndication standpoint. The second question to ask is, okay, hey, one sec, I got a cough here. Sorry. I'm sorry about that. You can cut that out, I assume.
Yeah.
Okay, sorry.
No worries, boss.
The second thing, so you've got fees. Fees are wild, or can be extraordinary, because most people don't necessarily ask. Me and you, we're used to 2 and 20, 2% management fee, 20% LPGP split. Well, ask that question, because I've seen some outrageous stuff. I've read some PPMs, man, where I was like, I read that wrong. There's no way. Because I get a lot of my buddies will come because they know I'm in the oil business. They'll be, someone's pitching them an oil and gas deal. They'll just shoot, hey, what do you think of this? And I'll read these and I'm like, did you actually read this PPM? And they'll be like, I mean, a lot of times what they'll do is, it's a 600-page PPM, and it's like, okay, well, this thing's over 600 pages. Like, they're trying to hide something in here. Like, we don't need a 600-page PPM. They're trying to hide something in there. So first off, ask your sponsor, what are the fees? Second, ask the sponsor what the capital is going towards. Because if you are looking at tax benefits, if your number one reason for looking at oil and gas is, I need a tax deduction, I would rather not pay Uncle Sam $100,000, and I'd rather see if I can deduct that from my taxes. Make sure the fund you're investing in is actually drilling wells. Because if they're not drilling wells and just buying producing wells, well, then all of a sudden, you're not actually getting the tax deduction. And two, along that same standpoint, make sure that they understand how to maximize your tax benefit. What do I mean by that? From a limited partner standpoint, if you're an LP in a oil and gas partnership, you can deduct losses, aka the IDC tax credits, up to your level of passive income. That's fine. But wait a second. I'm trying to deduct it from my active income. Well, really, you can deduct it from your active income if you're a general partner. And so how most of these funds do this, and this is a very common structure in the oil and gas business, is technically when you invest for the first year, you're actually a general partner, because then you get the IDC tax benefit. Then on January 1st of the next year, they'll convert you to a limited partner, so that then you continue to get the depreciation along that 5-year time frame. But I've seen some people who hey, look at this deal, I'm going to be able to get a bunch of tax deduction. I look at it and say, well, there's no mention of the LP to GP or the GP to LP conversion after a year. Watch out, because you may not actually be able to take that and write that off your active income. Because think about it. I talked to a guy 3 days ago who's making $1 million a year working as a software engineer in Silicon Valley. $1 million a year. That's pretty insane on a W-2 salary. He's getting raked over the coals in taxes, though, sitting in San Francisco. Holy smokes. But think about it. He's only going to be able to deduct that from his active income if he's technically a general partner. So their nuances there are interesting, and you always want to make sure to ask your sponsors the question. Now, you've got oil and gas syndications, but then you also have the direct working interest, or we call it the direct investment. Really, it's called direct working interest. And this is actually what we specialize in at Trevino Resources. We do have a traditional fund model, which is useful if you have to raise a bunch of money. You need to raise $10 to $100 million. It's going to make a lot more sense to do it in a traditional GP-LP syndication. But if you want to raise smaller pockets of capital, and or you have, 5 people who need tax deductions, well, we can actually have them invest directly in oil and gas wells and can kind of bypass the whole syndication model and just basically bring it to you directly. It's no different than if you bought an apartment complex and then decided to literally sell 2% of that apartment complex directly to another investor. Not through a fund, not through an SPV, but specifically just, I'm selling you 2%. And so we do the majority of our capital raising, or the majority of the capital that we raise in partnerships that we strike, are through this direct working interest model, which means you're a physical owner, which also means you're always going to be a quote unquote general partner, which is great because then you'll always get the tax deductions. There's no LP GP split. You're just basically, I'm buying 2% of this project, which means I get 2% of the revenue. I pay my 2% of expenses, but hopefully there's a net profit in there. So it's very easy to calculate and underwrite from an LP, from an investor standpoint. And it really aligns the incentives with the sponsor better. Because think about it, in a syndication, the sponsor may not be putting up that much money. They may be raising 100%, they may be raising $10 million, only putting in $500K themselves. And then that $10 million is going to go drill all the wells, and they're getting a 20% carry. Okay, maybe you're comfortable with that. But on direct working interest, if you own 2%, well, that means you pay 2% of the capital costs. And generally what happens is the investment amount covers the capital costs for that 2%. So in our case, what we do is we'll go buy 100% or 80% working interest in a project. We'll sell down 40%, and then, meaning at the end of it, we'll have 40%, our investors will have 40%, and then 20% is owned by other industry partners. And then we will go commence drilling wells, which means 40% of the costs come from our investors. We have to pay 40% of our costs, and the other 40% of the costs come from the other industry partners, which from my standpoint, as somebody who also invests in multiple asset classes, there's an incentive alignment that's much, much better, because I'm putting up a lot more of my own money to go in and do these projects, and we're really investing alongside the person. We're not selling down 100% and trying to keep a carry and there's a waterfall. Yes, that's people in real estate enjoy, or I wouldn't say enjoy that, understand that, because that's a lot of how real estate's done. But the direct working interest model, I think, aligns the incentives a lot better between the quote unquote sponsor and the individual investor. Now, as I mentioned, the downside to that is, someone's got to acquire 100% of the property prior to drilling it or prior to doing it. So that means that we have to have a lot of money to be able to come in and buy it and then sell down our position and then fund it to go drill. That means we're limited in the properties we can buy. We're not ExxonMobil. We're not Chevron. We don't just have $1 billion line of credit sitting there with JP Morgan. So there's a limitation to the size of projects that you can do under that model. So it's really both can work. I think you just have to understand as an investor the pros and cons of both and really understand, what's my goal? Is my goal to be part of a project that will get sold to Chevron? If you're just looking to make 5x on your money, maybe a syndication's probably the way to go, because you've got a higher likelihood of being able to sell a syndicated oil and gas deal, because there's going to be more production, more projects in it than doing a direct investment, because that direct investment may only be 5 to 10 wells, and those 5 to 10 wells may not necessarily be attractive to a large company. But on the other hand, if you're looking to maximize cash flow and maximize your tax deduction, I generally point people towards the direct working interest, because nobody gets better tax benefits than when you invest directly. And it's much simpler from a cash flow standpoint to kind of calculate what you're going to make. And, just personally, I've invested both via syndications in oil and gas and directly. My direct working interest has always outperformed my syndicated deals. Now, a few of my syndicated deals have actually achieved some liquidity events, which has been nice, but just comparing month-to-month cash flows, your direct working interest will always be higher, because you just own that physical percentage. You're not getting diluted by other investors. You're not getting, as that syndication raised more money, you're not necessarily getting diluted. Is a little, there's kind of less stuff in there. So it's really a combination of those two different models and what the investor's end goal is.
All right. Well, it seems like the investor's end goal is always to make money, though, right?
Yes.
So is that where you're seeing like a good alpha here for the rest of the year, or for 2025, like your thesis, and kind of diving all in on, what you're seeing here?
Yeah. So I think in 2025, I always come back to the standpoint of, if you're paying taxes, just call us and we'll talk you through how we can at least save you money on taxes. Because when all else fails, you can reduce your tax liability investing in oil and gas directly tremendously. Now, if cash flow on a month-to-month basis is your critical driver, then yes, Maybe direct oil and gas investments is the move. If, hey, I'm not necessarily as interested, I want some cash flow month to month, but really I want a huge exit multiple. I want to basically park my 100 grand somewhere. And then in 5 years, I want to say it's worth 400 grand. Okay, great. Maybe then you're more apt for a syndication model, which is maybe going to have a little bit less cash flow. It's going to have some, but it's going to have a much higher chance of an exit multiple. So that's what we see. I think obviously, we're recording this, 10 days left in the year. If you got a tax problem, then in the next 10 days, direct oil and gas investment should be your move because you can very easily solve that tax problem that way. I think moving into 2025, what we'll see is I don't think the difference between the syndication and direct working interest necessarily there's an alpha between them. What I think there's an alpha is in the type of projects that go in these direct working interest and syndicated models. And really that's the difference between horizontal and vertical drilling. Right now, all the rage is horizontal drilling. That's what's going on in Midland right now. It's what's going on in New Mexico. It's what's going on offshore. Everybody's drilling horizontal wells. Well, literally, they'll drill down, they'll turn the bit, and literally drill a 2-mile horizontal lateral. Huge cost of capital to do that. Huge amounts of oil production that you theoretically need to get. And so, but at the end of the day, the balance is how much are you spending versus how much oil production you're getting. And that's where all the capital is being spent, which means the cost is going up. Where I believe and where Trevino, we believe the alpha is in shallow vertical drilling. I mean, we have a rig on location right now that's drilling a 2,000-foot vertical well. Hell, we can just go grab shovels, man, and we can go knock one out right next to it, while the other one's drilling, which is, I joke with people and they love that, which is much lower cost, much less, not riskier because there's always a risk when you're drilling, but much less chance of complications while drilling. It only takes 2 days to drill. And your oil production is much more steady than it is super choppy or, really logarithmic from a horizontal standpoint. So truly where we believe the alpha is going to these shallow conventional fields that have really been passed over by the large companies. And we're able to get them at extremely attractive deals and really being able to provide massive, massive value to both us and then our partners. So that's really where I think the alpha is. Shallow, conventional, vertical production. It's not sexy, but cash flow sexy in my opinion. So it really is.
Yeah, there we go. Well, Michael, you've been very generous with your time, so I appreciate you coming on the show. Why don't you tell everybody where they could find you and what you got going on?
Absolutely. So you can check us out at TrevinoResources.com. You can always find me on LinkedIn, Michael Tanner. I love just talking with everybody. I do have my own podcast. I have my own news website called EnergyNewsBeat.com. If you just want to stay up to speed on the energy and oil and gas business, much like you, Brandon, I got my own podcast. So you can just find us on Spotify, iTunes, wherever. But not sure when this is going to come out. But if you do end up having a tax problem, let me know. I'm happy to point you in the right direction to help solve that. And if you're interested just in investing in oil and gas, love to chat with you. But really, Brandon, I appreciate your time and let me come on and rant a little bit. We could do this for hours, so we got to cut you off.
Of course, man. I had to cut you off to leave a little cliffhanger for potential more topics here coming up. So I appreciate you coming on, and I'll put all that in the show notes as well. So everybody check out Michael's podcast. As you can hear, he brings the heat, man. He brings the energy. So go ahead and check it all out. And Mike, thanks so much.
Thank you for tuning in to the latest episode of the State of Bitcoin podcast. If you really enjoyed this one, I've got another one cooking up for you. You can click that right here and you can go to the next episode, which is an absolute banger where I'm bringing you only the latest and greatest guests. Or if you're looking for more macro related content, you could check out my other channel, Macro Insights Pod. I got it linked for you right here. So where I'm bringing you more about stocks, real estate, traditional finance stuff. So go ahead and check that out. And if you enjoyed this podcast, go ahead and hit that like, hit that subscribe button, and tell a friend to tell a friend. All right, enough from me. I'll see you at the next one.